Welcome back. I'm John Alexandroff. I'm here with Bill Murphy of Fairway Independent Mortgage Company. And Bill, two things always get asked of me, as somebody who refers business people for mortgage loans or business loans. People are always asking me two things. Are there any special financing programs out there? And where are rates headed?
Sure.
And of course, if I had a crystal ball,
yeah.
or you had a crystal ball, we could tell people where rates are headed. But first, let's talk about any sort of special financing programs or mortgage programs that are currently available at Fairway Independent Mortgage Company.
Sure. There's always the conventional financing,
Yeah.
anywhere between 5% down or more was your Fannie and Freddie Mac. That's your vanilla conventional
Yeah.
financing. That's available. It's still available. Even there's talk of putting 20% down,
Yeah.
and that doesn't look like that's going to get passed because there's always going to be PMI. As long as there's private mortgage insurance, you can get conventional financing with 5% down,
Right.
and a decent credit score.
Right.
There's a fallback has always been FHA financing.
Right.
That's the government-backed loan. The problem now, it's been trendy for the last several years. The problem now with FHA is it's increasingly more expensive.
You only have to put 3% down.
3.5% down,
Right.
and the PMI costs have almost tripled.
Right.
Tripled on a monthly basis in the last couple of years.
So I think people have to do a little analysis. Does it make sense for me to put that extra 1.5%,
Right.
3%,
Right.
5% down, not to have to pay the FHA guarantee fee or the
Right.
insurance fee? Because I know just from watching the markets myself, and those fees are almost becoming almost too expensive for
Yeah.
people to really
Yeah.
to do those programs.
It kind of offsets the home affordability.
Right.
It's a fallback. It's a last resort. I think in a lot of cases,
Yeah.
there's some good. It can get someone into a home,
Yeah.
and then we work on some things, and we can
Refinance them
later.
Yeah.
But we always, we coach them through it, and we put them in that situation where they can better themselves. So, but what's really hot right now in the market for Massachusetts is mass housing. We're doing more and more mass housing for.
How does that work?
First, it's geared towards a first-time home buyer, and it requires 3% down on a single family, 5% on a multifamily. And with the mass housing, it is income restricted, and the income in Worcester County, because we're just talking
Right.
locally here, Worcester County is you can make up to, I think it's 112,000.
That's still
it's
pretty good.
aggressive.
Yeah,
it's pretty aggressive.
Very aggressive.
And so we're putting a lot of first-time home
So
buyers.
you can make $100,000 a year
Yeah.
as a family or as a couple or
Yeah.
as an individual,
Yeah.
and you still get the mass housing
Right.
guarantee in order for you to
Right.
buy a home. That's fantastic.
It's a great program, and there's a lot of other perks. I mean, if there's unemployment, if they'll pay the mortgage
Right.
up to 6 months of that. So there's some built-in protection there. With mass housing, the rate is the same across the board. I mean, you need certain credit scores. It's a 680 with 5.
Well, that's typical anyways.
But it's aggressive and it's a good loan, and with the income's aggressive. So with mass housing, that's been the way we've been taking the alternative of the FHA, because the FHA is so expensive now. If they can qualify mass housing, they're first-time home buyer. But what I wanted to mention is not only can they be a first-time home buyer, they can refinance into a mass housing loan. So if they have PMI, there's a way to take them out of the PMI as long as they don't exceed those income restrictions. And we say first-time home buyer, but the way mass housing looks at it is if you haven't owned a home in 3 years, you can still qualify. So basically, if you haven't claimed it on your claimed the home on your tax returns in 3 years, that's what they're going to look at, 3 years of tax returns. So where does this apply? It applies a lot of divorce situations where the spouse, the ex, one of them is rented for a few years, go back on their feet, they're ready to buy again.
Right.
So that's a great program.
That's a phenomenal.
Yeah, so it works. So it's not only first-time home buyers. I mean, I've put people in there that owned home 5 years ago, and we put them into mass housing, which is very beneficial.
So Bill, you talked about traditional loans, FHA,
Yeah.
the mass housing, which sounds like a phenomenal program. years ago, one of the hot things, and I'm self-employed, was, self-employed borrowers.
Right.
Is that coming back at all, where self-employed borrowers are able to access capital again? I mean, for a while, that was pretty much shut off, and I don't know if anything is.
Yeah, as long as they show the income to qualify.
Right,
I mean,
sure.
but they know that. I mean, you gotta have income to qualify. So you write everything off and you don't show income. Well, then if you're trying to buy a house, it's going to be a lot more difficult. Yeah. So I mean, you gotta do what's right. You gotta file your taxes correctly, and then if you qualify, that's gonna.
Well, this is good to know. I mean, because for a while there, even if you were showing tax returns, I mean, a lot of lenders are shying away from self-employed borrowers. And it seems to me like maybe now that's loosening up a little bit, where if you do have your tax returns properly prepared and you're able to verify your income, then you're going to be able to access capital again.
Yeah. It's definitely it's the way it should be.
Right.
We just got away from it. The stated income. No job, no income.
Just pure
days
credit
are gone.
score.
Those days are gone.
Yeah.
Those days are gone.
Yeah.
So I mean, this is how it should be, and it's where it is. I mean, there's a lot of talk that lending guidelines are too strict and they're too tight. They may have over tightened a little bit. It's fine because everyone has to play by the same rules, and you just you transition.
Well, Bill, you mentioned one other thing earlier in the segment about coaching people. So there must be people who come to you who maybe are on the borderline of qualifying for a loan, or maybe there's a credit issue or an employment issue, family issue, and I know you well enough to know that you don't give up on those people.
Right.
That somehow, some way, you coach them. It might not mean that tomorrow they're going to qualify for a loan, but maybe a month from now they will, or 4 months from now, or 6 months from now. And you help them get their finances in order so they do qualify for them at some point.
We'll look at it. We'll look at a credit report, and if it shows some blemishes or some challenges there, we'll go through that and we'll tell them what they need to do. So I hold them accountable because I'll tell them what they need to do in order to get approved.
Right.
And, if it's working through a credit issue, if it's working through some income documentation, or whatever the case may be, we'll work through it and we'll stay with them. But we give homework assignments, and
great.
Because they're gonna have some skin in the.
But here's what I like about this.
Right.
Yeah, this is what I like about this.
Commitment on both ends.
parts. See, if you go to the big bank, they're not going to do that.
No,
and quite honestly, if you go to even like a local credit union, I'm not putting anybody down. But even if you go to a local credit union or a smaller bank, they have restrictions, on what the bank policies will or will not allow them to do.
Right.
And in your case, you really act almost, this is not your title and you're not putting yourself out there, but you almost act like a financial coach. And you say, hey, this is what you need to do. Yeah. You do these things and you make the commitment to get these things done. We're going to get you a loan.
Yeah, and that happens. We do that every day. I mean, we have clients that we've been working with almost, there's been times we've been working with them for a couple of years and they finally get to purchase their house. I mean,
and then you got a client for life.
Yeah, some are a couple months, and we try to do as much business as we can by referral.
Right.
So we want to do a great job, and we want you to we want our clients to send us their family and friends because they trust us and they know we're going to help them.
Well, Bill, we're going to take a short break right now. I want you to get prepared for this. So we're going to have you put the hat on. We're going to have you look into the crystal ball, and we're going to talk about interest rates.
Sure.
Okay.
Got it.